Welcome back, everybody. We are now going to move to our final panel discussion, which is going to be on the exciting topic of digital assets and the revolution they're taking place. This is a panel brought to you by our sponsors, OSL Group, and we'll be hearing first from Mr. Wayne Trench, Chief Executive Officer, OSL. Wayne oversees all of OSL's activities, including trading and brokerage operations, product development, and governance. He has more than 15 years experience in digital assets, investment banking, trading and finance. Prior to joining OSL, Wayne held senior roles in major financial institutions, including as CEO of Octagon Strategy and Asia Head of Electronic Trading Coverage for Morgan Stanley. He's also an entrepreneur, co-founding Aspire, a diversified mineral processing technology and equipment supplier in Australia, which was acquired by the Ware Group in 2013. So quite accomplished, and now heading OSL and going to talk to us about the revolution of digital assets and impact on private wealth. Wayne, the stage's yours.
Well, thanks, Mashir. What an invite. Thank you very much. It's an absolute pleasure to be presenting today. Look, I think it's very, very timely for us to be having a conversation about digital assets and the potential impact on the private wealth sector, as there's been a significant uptick in both inquiries and, in fact, adoption of digital assets amongst wealth managers, private banks, and family offices in recent times. So today I'm going to be just talking a little bit about a number of areas related to the digital asset space, including who's involved, what the space actually encompasses and what it means, why it's here to stay, what's driven the recent price action in crypto, and finally, how and why it's actually quite simple to get involved. Look, I think it's pretty obvious that digital assets, and in particular, Bitcoin, has dominated headlines in 2020. And it's quite obvious that the price action has thrust it back into mainstream conversations, much the same way that it did in late 2017. I think in this instance, the macro drivers behind this move are pretty obvious, with QE ongoing in many, many major economies around the world, which is really driving investors to explore options for inflationary hedges and so on. Every day in what we're doing, we're seeing more and more major household names really enter this space. Some of the ones that have garnered attention are listed on the slide there, which include Goldman Sachs, Fidelity, Facebook, PayPal, Paul Tudor Jones, and the like. And closer to home, we've also more recently seen both DBS and Standard Chartered announcing their participation in the space. Now, for OSL within our own business, we have seen a massive uptick in both onboarding and trading from major traditional funds, family offices, and the like in recent times. And that trend is only accelerating. And there's a number of factors why that is the case, and I'll sort of touch on those a little bit later on. While it's relatively early days for digital assets as a whole, it's arguably been 3 decades since we've had a genuinely new asset class available to investors. And perhaps more importantly, one that's really custom made for what we call the born digital generation. Many call them millennials. I guess for Bitcoin in particular, this decade-long testing phase that it's been going through has been quite a journey. For those of us who've been on it for a while, it's certainly been a roller coaster ride. But I think it's now become clear that we've passed that inflection point, and Bitcoin specifically, and in fact crypto and digital assets more generally, is well and truly here to stay. One thing that's important to note, though, is that digital assets encompass much more than just cryptocurrencies. In fact, there's some concepts known as STOs, so security token offerings, or ABTs, asset-backed tokens, are emerging as a potentially more efficient and effective route to take for doing traditional market things like raising capital, fractionalizing assets, and the like. And in our view, this uptake will really gather pace going forward, given the number of advantages that this technology has to offer. In fact, we believe that the underlying technology will in fact be the fabric that underpins capital markets and asset classes of the future. Look, it would be remiss of me to talk about digital assets without talking a little bit about price and performance. And look, certainly the rally in Bitcoin recently has got a lot of attention. But I think it's worth noting that this phenomenon has been much longer dated. If you look at the slide, this gives you a sense for the risk-adjusted performance of Bitcoin versus major asset classes, and it is the top line in orange. It's been a clear outperformer. In fact, our analysts internally have done some analysis on what a mere 1% allocation to Bitcoin from 2015 up until now would have done for a diversified portfolio. And actually, the annualized outperformance is astounding. It's in excess of 1.2% annualized over that period of time. And if you look at what a 5% allocation to Bitcoin would have done, it's about 5 to 6 times that, which is particularly significant. One thing that I'd want to point out, though, about this recent rally in Bitcoin prices is that it's vastly different to what we saw take place in 2017, in that it is 100% being led by institutional activity. And I think this institutional activity has really come to the market because a number of the historical hurdles have been overcome. And I want to sort of talk about these hurdles or myths, if you will. So I guess the first hurdle, or what we called myth number one, is that crypto isn't regulated. Now, historically, that has been the case, but now we have a significant number of high-quality jurisdictions around the world that have brought regulatory regimes to bear. And in fact, both in Japan and closer to home for us in Hong Kong, the SFC has actually been very forward-thinking and innovative in this regard. Innovative while still ensuring the utmost level of investor protection. And in fact, we believe Hong Kong has set the standard in many ways for other tier one regulators to follow. So that hurdle has been overcome. The second hurdle that we've often talked about with institutional investors has been the risk from an AML and KYC or compliance perspective. Now, the reality is that for digital assets, in fact, there are tools which provide even greater levels of transparency over the quality of the assets that you're dealing with. So in addition to employing best-in-class KYC and AML programs, much in the same way that traditional banks do, as well as transaction monitoring capabilities, there's also a concept called coin purity or know your token, which leverages blockchain technology to actually explore and interrogate the history all the way back to the beginning of time of a particular digital asset that you're holding. Now, when we show this technology to traditional banking compliance teams, they're amazed and they want to get their hands on it because it's so much more thorough. So I think that's a second myth that has been debunked and institutions are taking notice. Thirdly, is custody. Now, we've heard plenty of times of people losing their assets, their digital assets or crypto in time gone by. And that has been a significant challenge. But now there are a meaningful number of quality custodians around the world who are both regulated, or in our case, insured by Big Four auditors, and even audited by Big Four auditors, and even insured. So I think that was a very, very key component as well for the institutional segment of the market to make sure that they had the safety and the surety about the protecting their assets. So I think with all, and it's really solving those problems that have led to this recent price action, and frankly, we do expect that to continue. Given that price action, there's obviously plenty of appetite in the mainstream public, but also in the financial markets in particular, to participate in digital assets. But outside of those three myths which you've just spoken about, one of the other big challenges is just how do you get started? One thing I'd point out here is that it's important to remember that there are major banks and major financial institutions who are already well down that journey. So they've proven that this is absolutely possible. And it's the banks that have been quite forward thinking are those in particular who've got clear strategies around the millennial segment or the born digital segment of the market. Now, with respect to ways in which you can engage in the space, there's a number of different approaches with varying levels of capital investment required. On one end of the spectrum, traditional banks and wealth managers can consider fully building technology solutions on their own. But I think once you go down that path, it becomes quite obvious that there's a pretty meaningful knowledge gap in order to execute that strategy. The good news is, though, that whilst there aren't that many options, there are institutional grade platforms available in the market, and institutional grade infrastructure now does exist. And I'll share just quickly a little bit about the types of products that are available in the market now, which has again led to this institutional participation. So firstly, we'll talk about the brokerage element of the market. So much like traditional brokerage businesses, digital asset brokers offer things like OTC facilitation trading, electronic trading, coin borrowing and lending, swaps, margin trading, and all of the things you'd be familiar with in traditional assets. It's definitely much earlier stage and it's quite boutique, but that does exist. Secondly, the spot exchange and leverage swap exchange trading. Again, there's a plethora of exchanges that are unregulated in the marketplace. But for the institutional and professional investors who are looking to trade on regulated venues, they do exist. And those higher quality regulated venues have both fixed connectivity, market surveillance, transaction monitoring, and as I said before, coin purity as well, to really give compliance teams, regulators, and individual investors the comfort they need to trade there. Thirdly, is the custody segment, which I've spoken about already. And the need to have insured custody is very real. But finally, for those considering how do I enter this space and how can I offer a solution to my customers, is the advent of proper institutional grade software as a service offerings. And from our perspective, that's certainly an area where we focused a lot. We do have the ability to actually white label any or all of our brokerage, exchange, or custody products to other banks, brokers, and intermediaries who are looking to offer a digital asset solution to their customers. And in fact, we did recently announce that DBS's digital exchange, we are actually providing the technology for their platform. So I guess that to us is indicative of the fact that real institutions are getting involved, and the time to act really is now. So in closing, before I pass over to the panelists, I want to thank everyone again for having me. Look, we think it's a really, really exciting time, not only for those of us who are already in the digital asset space, but certainly for those in traditional finance community, whether it be on the commercial or technology side, as we do feel like this technology has a major role to play in the financial markets of the future. My team and I are on standby to take any questions if and when you have them. So please don't hesitate to reach out. And I'll hand you over to the panelists now. Thank you very much.
Thanks a lot, Wayne. It was quite interesting to hear about the industry and what OSL has been doing there. We'll now hand over to Professor Douglas Arner, a Kelly Professor of Law at the University of Hong Kong, and not to mention a very distinguished expert in the space of blockchain and digital assets, having written a lot of thought leadership papers for BIS and other places. So I'll hand over to Douglas to start the panel and then have the speakers introduce themselves accordingly. Douglas, over to you. Thank you.
Thanks a lot, Bashir. And congratulations to AFO and Virtual FinTech Fair on putting together this Asia WealthTech Forum. I think it's an incredibly exciting area moving forward. And as you say, this is really a great panel. Thanks, Wayne, for, I think, presenting one of the big issues, which I think we're all going to be talking about, which is really some transformations we're seeing. We're seeing a sort of mainstreaming, a normalization of digital assets. And with me today, I've got Avaneesh Acquilla from Arrano Capital, Henri Arslanian from PwC, Matt Long from OSL, and Emma Pecenicic from BNP Paribas. And really looking forward to hearing what everybody has to say. And I think when we look at this panel, we look at things from the standpoint of digital assets and private wealth. The first is really this question around what we're seeing. What are the directions going ahead? The second is really thinking about the wider impact of blockchain and the technology on the sector, on asset management. And the third is something that I think we're all seeing moving pretty rapidly, and that is trends in central bank digital currencies like the ECNY, and in particular, stable coins. And I want to kick off with Avaneesh. Avaneesh, what are you seeing from the standpoint of market trends going forward?
Yeah, thanks, Douglas, and thanks, Wayne, for the introduction. I want to develop a few the ideas, especially some of the things that Wayne is talking about with regard to the institutional adoption. And so, like when we talk about trends and we talk about the way we think the market's going to evolve in the future, this recent trend of institutional adoption and institutional entrance to the market is really been a big one for this year. I think it's not just myself, but I think most of the people who've been following the space for the last few years would agree that 2017 was much more speculative in terms of the inflows we were seeing. This time, it's definitely driven by much more serious institutional entrance to the marketplace. And, at the end of the day, if you want institutions, you need the space to be regulated, because institutions won't invest unless there's regulation. So we've seen a big step forward this year in terms of those regulatory frameworks. We're in the asset management business, and so there's very clear framework and guidelines on digital asset managers in Hong Kong. And so I expect to see more digital asset managers licensed by the SFC in Hong Kong. That's a trend that I expect to continue. And it's a very circular argument. So when I mentioned that if you want the institutions in the market, then you need regulation. Well, the bigger the market gets, the more the regulators will care. And so, what I see going forward is that we're going to see actually tighter regulation, so that, there's obviously pros and cons with that. It should be a safer place for investors, and there should be more transparency. But obviously with more regulation, then it definitely creates some barriers to entry for retail investors, and it creates more sort of red tape and bureaucracy on that side. But I think it's just a fact of life that we're going to see more regulation. I think we're going to see more AML scrutiny. In the US, there's a trend at the moment to really look at the self-hosted wallets, and a question mark around, well, how do we KYC, AML, those self-hosted wallets? In the past, they've tended to be ignored, and now the US is taking the view that, well, transactions of over $10,000, even with self-hosted wallets, should be subject to the normal KYC, AML procedure. So I think that's just one of the things that, like I say, there's pros and cons, but that's definitely a fact of life, that the regulatory environment is going to become more and more entrenched, and ultimately it is a better thing in terms of institutional adoption and the overall size of the market. And then just one other thing I would add, which I expect to continue to see a lot of growth, would be the derivative side. As you see more institutional investors, as you see more licensed fund products, you're going to see those managers want to trade derivatives, not just on Bitcoin, but on Ether and the rest of the ecosystem. And so I think, that's quite exciting. We're going to see an explosion of those types of products.
Yeah, thanks for that, Avaneesh. And I think that's exactly right, that it's an interesting thing that for the industry to really succeed, it has to become more regulated. And this really is from the standpoint of normalization of investors. And I think that's very much what we're seeing. Henri, turning to you, what are you seeing from the standpoint of big global trends for
Oh, absolutely. I mean, I think this is the most exciting time when it comes to the future of money. And of course, what's happening with cryptocurrencies is a big driver of that. I think for a lot of the family office and the families listening to this, some of the big trends that I'm watching now, one is actually what Wayne and Avaneesh talked about, is the industry becoming institutionalized. Literally, if you look at the last 2020, numerous banks came out and made their plans public. Wayne mentioned DBS, it was JP Morgan and others that came out with their plans. But I think what's really interesting for a lot of the IFAs in the room and those in the wealth management sector, it's not in the private banking world yet. And actually, even last week, one of the large private banks came out with a report saying that Bitcoin can even go to zero. Many would argue that it's tough as a private bank to sell or promote Bitcoin when there's no product that you can sell and make money out of it. But I think that's something to understand. I think from that we're seeing from that perspective. And second, I think for a lot of the family offices looking at this as well, is a part of the whole industry becoming institutionalized. You also have a pretty interesting retail interest as well. I mean, just to put things in perspective, Douglas, 5 years ago, there was only 5 million people with an account at a crypto exchange. And last quarter, there were over 100 million. And I'm not even counting the 280 million Americans who now can buy Bitcoin using their PayPal app seamlessly. So there's a lot of retail interest. And again, for the IFAs in the room, especially the millennials. I mean, just to give an example, from 2018, 2019, the percentage of Americans who went from owning Bitcoin went from 8% to 14%. That's an 80% rise in 1 year. And by the way, what's interesting is when, again, according to the same surveys, 17% of millennials, again, this is a Finder survey, claim to own Bitcoin, whereas the number is less than 2% for baby boomers. So there's a generational thing as well. I mean, putting my professor on, I often tell a lot of people in this industry, the next time you have a family dinner, COVID permitting, ask the youngest member in your family what he thinks about Bitcoin. You'll be surprised how much information they may have. And maybe the last final point that I mentioned is often the industry is becoming not only institutionalized, but a lot of people from the traditional financial industry are coming in. A great example, you see on this panel, people like Matt, Wayne, Avaneesh, and actually everybody who's actually was in traditional financial industry coming into space. And I think that brings a lot of to the industry the experience and expertise that the industry deserves. And even for a lot of you listeners today, a lot of the family officers, the advisors, the one thing that I often say is that you'll be surprised how much of your clients are interested in this. And the one thing, if there's one takeaway today, is education. I think you may love Bitcoin, you may hate it, you may love cryptocurrencies, you may hate it, but I think we have this intellectual duty to at least learn about it, understand what it is. And there's a lot of tools out there. There's YouTube pages, free. There's my book. If for those who are interested, there's my YouTube page. There's a lot of free tools right now that allows you to get educated on a topic. And this is the most exciting time of in the history of money. So nothing better than doing that, especially if you're stuck at home watching Netflix. Learning about Bitcoin is way better. I'll pass it back to you, Douglas.
Yeah, no, I think that describes something that we've seen a big trend in across this year, which is trade assets instead of watch Netflix. And certainly that has been something that we've seen in the context really of the US and also mainland China. And I think if we look at what Wayne, Avaneesh, and Henri have said, the first is this point that increasingly crypto and digital assets have become a normal asset class. We're seeing this both from the standpoint of investment interest as well as broadening of investor participation. We're also seeing it very much from the regulatory standpoint, particularly at the global level. Particularly, I think we can see some initiatives in the EU last year and some real moves starting off fast in the US this year. I want to turn to Matt. Matt, from the standpoint of what we're seeing in Hong Kong, from the standpoint of normalization and opportunities, what do you see?
Thanks, Douglas. Look, what we're seeing does really reflect what Henri's spoken about and also Avaneesh and Wayne. We've crossed the Rubicon when it comes to adoption. And in the last sort of 6 to 9 months, the interest from multifamily offices, from traditional hedge funds, from genuine asset allocators, the conversation has now moved into how do I allocate? And I think, as the myths have been debunked, it's now very much a question of how do I allocate? And so I think, in Hong Kong in particular, we're incredibly fortunate to have as Wayne alluded to, a regulator which has been extremely forward thinking in the development of the regulations and policy with respect to digital assets, both crypto and security tokens, and that has then afforded the ability for family offices, private banks to start moving into, in a very structured sense, how they deliver the product to customers. So, we spend a lot of time educating. We do a lot of lunch and learns with private bank product desks, with CIOs in family offices, and actually explaining to them, how the industry works, breaking down some of the myths, and then taking them on the process that, once you move beyond the understanding of the building blocks of the digital asset industry, it actually then allows them to start meeting the customer need. And that's what's really interesting, sitting behind all of this. There's such a strong demand to be putting digital assets into portfolios that the intermediaries now, as we say, they're playing catch-up footy. For an independent asset manager or for a small private bank, how do I actually meet my next-gen wealth targets of being able to offer a Bitcoin solution? How do I do that as an IAM? How do I do that as a private bank? And so those solutions are all now sort of coming online. So looking forward, I think this year you're going to see more and more of those solutions sort of come into place. Security tokens is the other, we think, very significant industry that will evolve over the rest of this year and into next year. I think for a lot of people, since the ICO boom of 2017, it's sort of been this is going to be the next thing, this will be the next thing. The regulation that's been put into place now in Hong Kong, which does afford the opportunity to actually list security tokens, we think that it's game changing, and game changing in a global context.
Yeah, I think that's exactly right, and it's something that it's interesting to see from the standpoint of STOs that where the real success is likely to come is from a regulated market, and we're seeing some real movement in the EU context, and I think with the new U.S. administration we're going to see that here, in the U.S. too, and that will then feed through to other jurisdictions, including Hong Kong. And one thing that's come up, and I want to switch directions and turn to Emma here, and that is, it's interesting to see blockchain and digital assets coming increasingly into the traditional financial sector, not least to have, say, crypto analysts at JP Morgan or other investment banks. But what I wanted to bring you in is you work very much on asset management industry, on blockchain, on digital assets. And tell us a bit about what you're seeing, what sorts of outlook that we're going to see.
Thanks, Douglas. So at BNP Paribas Asset Management, basically what we think is that we are seeing a lot of benefits of tokenization for the traditional securities and the alternatives as well. And actually, we decided to focus more our work on alternatives. So when I say alternatives, I'm talking about the impact on hedge fund, venture capital, and infrastructure and private debt. So we manage infrastructure assets funds, and basically we are really exploring how it can impact this asset class to include infrastructure tokens in our portfolios. And from this perspective, we are seeing a lot of benefits. The first one being, in the token itself, you have the infrastructure debt asset, but as well a lot of other data that are embedded that can really help the credit analysts to do all their due diligence. So and basically have across the life cycle of the instrument, have as well regular updates that benefit as well on a regular basis the analysis. Secondly, it can help to decrease the cost associated with the investment itself, because on those alternative assets, there is a lot of cost involved in the structuring. And here there is an interesting statistics from the International Institute of Sustainable Development, saying that the overall cost associated with a project today is from 15 to 23% of the total cost of the project, and with blockchain it can be reduced to 5%. So there is a lot of benefit here. Then secondly, we can as well basically increase the distribution thanks to the fractionalization of the assets. So today, infrastructure assets are really sold to, institutional investors, usually insurance and so on. And basically here it could target smaller institutional investors or as well family offices, high net worth individuals. So this is really interesting for them as well, because they are usually higher yielding products. We can be as well innovative because we can potentially, thanks to that as well, offer shorter maturity product. And this linked to my other point that, to resonate, Matt comment as well on bringing liquidity by listing, securities token as well. Here, by listing the infrastructure asset token, we can help, provide more growth to the liquidity that we are starting just to see in this market. So this is really interesting. And overall as well, as an asset manager, when you include that in your infrastructure asset portfolio, you can access to smaller deals with basically a subsector that you didn't access before. So you provide, more diversification. For example, you can access small solar panel projects that you couldn't access, and in emerging market as well. So it's really interesting as well to finance the energy transition as well in emerging countries. So this is something that we are exploring, and this is really from the investment side, but as well in the structuring side of the product themselves. Since we are a fund manager, we are looking as well at the tokenization of the shares of the fund themselves. And here we're seeing as well similar benefits. So cost reduction. Here, from cost reduction, we have seen some asset manager trying to offer active equity fund at the same price as ETF. And this is something I think we will see more and more going forward, listing basically active equity funds that will compete with all those listed tracker fund. And secondly, opening a new distribution channel, such as having asset manager directly selling to the retail investors, or if the distributors are on the same network, we could offer more transparency and have a better reporting and interaction with end investors at least. And finally, faster settlement cycle, right? We could offer potentially money market funds that are accessible, instantaneously, hopefully, across the globe. So this is something that is attractive from our perspective as well.
Thanks, Emma. And I think that highlights a big point, and that is the difference between different portions of the market. You have your sort of traditional cryptocurrencies, which is one, but probably the biggest growth area is tokenization of a variety of other forms of assets. And probably key to making this work is to build trust into the markets, and that's really coming through regulation. One, allowing institutional participants in. Second, to have essentially regulated exchanges, and third, around custody systems. And I've seen a couple of comments in the chat around money laundering concerns. And what I want to turn to Matt and Avaneesh, and basically ask, from the standpoint of tokenization of new sorts of investments, what is the big advantage of having a license, a regulated entity? So maybe Matt first.
Sure, happy to go first, Doug. So I think if we step down just from table stakes, the regulated status provides investors the number one, that the framework and the counterparty that they are dealing with actually has and is supervised by in the case of Hong Kong, a major financial markets regulator. And so then all of the required regulatory oversight and requirements that come with that. So from regulated individuals, capitalization, ongoing oversight, ongoing inspections and audits. So I guess that sort of general framework that that regulation brings, it also brings a degree of familiarity and therefore a lower cost of entry and barrier to entry to new users. They're familiar with dealing with an entity. If I use ourselves as an example, that we're a Type 1 and Type 7 license, so a security token that would trade on our exchange, the users and the traders in that exchange are then quite familiar with the regulated environment that they're operating within. And obviously, then the recourse that they have, in circumstances where recourse is necessary. So I think that provides that fundamental, and regulation provides that fundamental bridge to adoption, which we didn't see in sort of the ICO sort of craze three or 4 years ago. The concept was very, very good in linking capital to those that needed it. Putting a regulatory framework around it, you still get all the benefits of the allocation of capital through the blockchain, but you've then got it in a safe regulatory framework. I think they're the main things that drive it and will drive the adoption of it. I think Emmanuelle's point is spot on. We are going to see rapid adoption of security tokens across infrastructure assets, across other hard assets, and then into other, even into more traditional capital market type assets like debt and equity.
Yeah, I think that's exactly right. And it really is about using the technology to create liquidity or transparency in the context of other forms of traditional assets.
Yeah, I'd agree with what Matt's contributed there, and also add, as a fund manager, investing in a product that is from a licensed fund manager, the investor should expect that they get better transparency and they have better investor protection. And so those are the two key things. And like as a licensed fund manager, obviously we have to adhere to the fund manager code of conduct. So the standards that we're being held to, they really reach across our organization and structure, our staff ethics, and our custody and trading practices. And so it's really a very deep level of requirements that you actually have to meet to be licensed. And as an investor, you would really want to see those things. If we talk specifically about security tokens, then why would I want to buy a security token that is under the remit of like a regulator such as the SFC? Well, you can be confident and comfortable in the fact that the security token meets the basic requirements that you would expect, because the issuance has been already vetted by the regulator. And so, I think it really, you should ask yourself the same questions, like, would you be comfortable buying equity in a company that's listed in a country that has very little regulatory, very low regulatory standards? You probably wouldn't, right? I think investors have comfort when they buy equities that are listed in the US or in Hong Kong or in the UK or in Europe, and because they know that those issuances and the issuers meet those basic regulatory standards in terms of the transparency and their own operating standards. And so, having security tokens that meet those standards, then it's going to avoid situations that we had with the ICO boom in 2017, when frankly, most of those were done at a very sort of low level of standing, and that created big problems and huge investor losses, right?
Yeah, I think that's exactly right. And certainly across the ICO boom, most of us would have said many of the products were financial products and probably securities. So the fact that the market has sort of come around to that fact and just deals with it, I think that's actually a very important aspect of this process of normalization. But that also relates to something that I think has been one of the big items of last year, but is really going to come across this year, and that is central bank digital currencies. Basically, central banks becoming directly involved in issuing digital currencies. And Henri, I wonder if you can give us a little bit of the context on what you see.
Oh, absolutely. I mean, if there's what's happening with Bitcoin is super exciting. What's really one area to watch in 2021 is central bank digital currencies. So I think there's two things to clarify here. So Bitcoin, as we discussed today, is a decentralized currency. Pretty much nobody can stop it. It's out there. The second type of asset that many people, I think a lot of people on the line should be aware, is a central bank digital currency, which is digital currency issued by the central bank, and that becomes part of the monetary base of the country. Again, just putting my professor Arrano for a second, today there's two kinds of central bank money. One is good old cash that you hold in your hand that you can put in your wallet, which is liability of the central bank. Second are the reserves that your lovely bank holds at the central bank. The money that you hold at your bank is not central bank money, but is actually kind of accounting entries with that bank. What is really exciting, Douglas, is that our generation, everybody listening to this session today, we will probably see a third form of central bank money, central bank digital currencies, which are pretty much a digital version of banknotes, and that's super exciting. And there's many reasons for that, many benefits from it. And again, I'm just saying, just to link it up to some of the questions that came in the chat, one of them is money laundering. Today, if I use cash or I deposit cash in a bank, pretty much nobody has any idea where it's coming from. And frankly, if you want to get involved in any illegal activities, you want to launder money, cash is still the best way of doing it. When it comes to central bank digital currencies, we'll be able to trace a lot of these transactions that are taking place. And also, there's a lot of policy decisions that we can take place. For example, seeing what is the impact of certain monetary policies, or even be able to actually embed monetary policy within the currency. Okay, that's a whole different discussion. But that's really one thing that we're seeing a lot. When it comes to this CBDC topic, all eyes in 2021 will be on China. Make no mistake, China is years ahead of any other country on this topic. The PBOC, the China Central Bank, has been researching this topic since 2014. That's 7 years ago. Put things in perspective, the UKFCA, the Bank of England, launched a consultation only 12 months ago. So there's a lot of work that China has been doing on it. Again, put things in context. The last phase that China did on this, there was over 2 billion RMB. That's $300 million of transactions that took place in 12,000 use cases. Let me repeat that: 12,000 use cases. And right now, even last weekend, there was a lottery where people were getting issued central bank digital currency. So very exciting. And that relates, I think, to one other point, Douglas, which are stable coins, which are, again, it's a digital currency. Let me use these chips for a second. That is backed one-to-one by fiat money. You would say, what's the point of that? Well, if I send you, Douglas, today Bitcoin, you'll be very happy, but we don't know what the price will be a week, a month, or a year from now. However, if I send you a stable coin, it will be worth $1 today, $1 a month ago, and 1 month, and in 1 year. And that has many, many, many benefits that we can discuss. But when it comes to, I guess, the wealth industry, look at cross-border payments. Today, the average fee of a cross-border payment is 7%. That's the average, by the way. It's double-digit in many emerging countries. That is unacceptable in an era that I can send a WhatsApp or an email for free, or we can have these great chats on these great platforms pretty much seamlessly. And that is one thing to watch in 2021, especially with Libra, now called DM, that is coming up, and that may really shuffle a lot of this thing. So I think there's something important for a lot of the family offices, a lot of the wealth advisors looking at the space. Whole area of CBDCs and stable coins, definitely something to watch in 2021.
Thanks for that, Henri. And I think the key point about a central bank digital currency is, as you say, this is money issued by the central bank. It may not be DLT. It's certainly unlikely to be a permissionless blockchain in most cases. It may even be a centralized system. And from the standpoint of anti-money laundering, this is programmable money, and it actually provides potentially a very significant solution. I want to turn to Emma on this, and I want to ask, if we think of China is certainly leading, Europe is also looking at this, but if we look at asset management, the the traditional financial services industry, and we think about the role of blockchain and digital assets, what's the intersection here? What's the role of central bank digital currencies?
Yes, thank you, Douglas. So they play a key role because if we want to have the overall tokenization of the financial markets, the cash settlement needs to happen somewhere, right? And you need to have the settlement to happen in a currency that you can trust and that is stable. And that's the main, importance of stablecoin in the overall system. And that's why, the regulation of the stablecoin is really important. So they can be really, per to the to the currency they are supposed to represent, or even better, central bank digital currency that the system can really trust. So if we want to really reap the benefits of the tokenization and really, afford financial products at a attractive price with smaller fees, we need those stablecoin and central bank digital currencies to be there so that we can really be even more innovative and reap the benefit, as I said.
Yeah, I think that's exactly right. And certainly if we think about China, if blockchain is a sort of national priority, one thing that you need to make systems work is a trustable monetary and payment instrument. And of course, in the context of China, you can't use alternatives. And so the development of a central bank digital currency, a state digital currency that can be embedded in those systems, is probably key to future success. Now, Matt, looking at GBA, what sorts of prospects are you seeing? What sorts of implications are you seeing from the standpoint of
Look, I think it features into what everything that we've been saying, Douglas, about the growth in digital assets and the uptake from intermediaries in Hong Kong. Really, I mean, if we take if we assume that the GBA is sort of going to evolve and WealthTech and Wealth Connect is going to evolve over the next half decade, that's going to sort of sit quite nicely with how digital assets actually converge into broader traditional financial portfolios. So what's going to be very interesting is as we say, as WealthTech opens up and there will be quite some restrictive products available and distribution channels available through that to begin with. But as that opens up over the next half decade and decade, you're also seeing the convergence of digital assets within asset management portfolios and within private wealth portfolios. So I think it's actually going to be a very nice evolution and harmonious evolution between the opening up of sort of Wealth Connect and GBA and the growth of digital currencies and digital assets within portfolios. And the other, I guess, bringing the other point into it is the role then of central bank digital currencies within those portfolios as well. Because again, if you take a bigger, longer term macro view, you're going to have people trading central bank currencies like they trade Aussie, how they trade cable, how they trade dollar yen now. You're actually going to wind up with all of those things sitting here within a portfolio within Greater Bay Area. It's it's pretty. I think it's pretty. It's not hard to see how that evolution actually evolves, and as the GBA grows and as things open up.
Yeah, and I think there's also a really exciting possibility from the standpoint of programmable money, which potentially allows the capital integration between Hong Kong and the GBA without losing capital controls from the standpoint of China to the rest of the world, but also allows Hong Kong to continue to maintain an open capital account. And this is something that we've seen some increasing discussion about. We're coming to the end. I've kind of been in parallel to our discussions, picking up on some of the things that have been going on in the chat box off to the side. But I just want to give the audience a chance, if anyone has any sort of explicit questions that you'd like to throw into the questions box or the chat box. And while we wait to see if anything comes up, I want to ask you all quickly from the standpoint of AML. At the Hong Kong and the international level, there has been a lot of attention. How much does this really address some of the real concerns around markets? And really, over to anybody who wants that one first.
Yeah, look, I'm happy to take that one first. As I said, we do a lot of lunch and learns, and that ranges from traditional private banks to global market desks at big banks, to consulting firms. We're passionate about this, so we talk to everyone and educate everyone. One of the first, if not the first question is, what about the money laundering aspect? It simply is always the first question. People, and I think as Wayne mentioned, is like people are left open-mouthed when you actually explain the simplicity of being able to look back across the blockchain at the provenance of a particular asset, and then you compare that to what it's like. If we take Henri's cash and we go and try and put it in the bank, and you've got to try to explain where the cash came from. This is chalk and cheese. You have one clear chain of provenance, which can be audited through digital assets, and therefore, if you're a criminal wanting to launder money, just doesn't sound like a very good idea, versus carrying a bag of cash around. So you get through that discussion, and it's as I said, people's jaws just go, yeah, okay, I get it.
It's something that I've seen over the past couple of years, as law enforcement in particular has gotten increasingly comfortable with the way these systems work. And actually, from a law enforcement standpoint, digital assets are actually a very effective tool from the standpoint of tracking entire networks of organizations that previously they weren't able to see. Anyone else on this point?
Sure. No, happy to add. I think Matt was spot on. Actually, but just to show how I think there's so much transparency in Bitcoin, for example, that I actually think one of the debates we're going to have as a society is that whether there's too much transparency in digital assets. For example, today, when I make a traditional bank transfer, let's say to OSL's fiat bank account, nobody can see a transaction. Right? Whereas if I send them a Bitcoin, that transaction is there. And actually with some good analytics and AI technology today, they can probably trace that back to myself. And that's why, by the way, they were able to trace over the last couple of months a lot of pedophile group, terrorist groups, even payments that were made a couple of weeks ago to the Washington riots that took place in early January. And I actually believe that we're going to have a debate as a society in the next couple of years on how much privacy we need and whether we should bring up privacy coins within regulated exchanges to allow privacy in payments. Because, for example, as we move on, more and more businesses start using it. There's ways of reverse engineer and try to get under the kimono of businesses. So I think there's actually a lot more transparency that, as Matt mentioned, than actually people are aware about. But again, when it comes to money laundering, again, anybody who's a criminal, anybody who's looking at laundering money or getting involved in illicit activities, one piece of advice: do not use Bitcoin or else you will get caught. It's almost certain right now. So I'll pass it back to you, Douglas.
Yeah, I think that's a very good point. And I think it's going to be a big discussion in a lot of places, particularly as central bank digital currencies develop and people think about the implications of the traceability of some of the structures. There's a question that I'm going to answer on behalf of the whole panel. And that question is, would the members of the panel be interested in the prospect of educating 20% of the globe's population every single week in the nuances of digital financial markets? I'm going to answer for this panel. That would be a yes. So we'll take that opportunity if it's available. And we're coming to the end of our time, but I'd just like to ask everybody on the panel for a one-liner on what do you see as the key point for digital assets and wealth tech in 2021, starting with Avaneesh.
Thanks, Douglas. Yeah, so my answers may be different from the others. Actually, what I want to see is open internet services, and I want to see decentralized applications that real consumers are using, and the beginnings of a token economy. So I'm talking about open source software, which we already have a lot of, but adding some incentive schemes like the tokenization of projects, and have developers be incentivized by payments in those tokens, and then have these beautiful decentralized open systems, have lots and lots of user growth, and have that really form the next phase of the internet, and what some people call Web3. So that's what I'm hoping to see.
Sounds good. Over.
Well, one thing I would love to see more in 2021 is education in this space. And again, my message to everybody, it's never been easier to get educated. And I hope more people, from financial advisors to bankers to regulators, policymakers, will do so in 2021. There's plenty of ways of doing it. Douglas Arner, your moderator, has excellent academic papers on a topic I highly recommend. You can go on YouTube. There's a lot of my stuff on my LinkedIn page, the shows. I really believe, like I mentioned before, we have this intellectual duty to at least understand what cryptocurrencies are about, and then we can make our own informed decision whether we like it or not. So education, education, education.
I would agree actually with the Henri education, and on this we do a bit of promotion. We are releasing a research paper on tokenization of alternative assets next week, so I invite the audience to read that if they want to understand more on the space.
Excellent. I think huge potential there. Matt?
You're on mute, Matt. The line of 2020 continues into 2021.
That's right. Look, thank you for that. Look, I think from me, and again, put the caveat on this, that this is not investment advice, but for wealth managers, for private bankers, for other people out there, go and buy digital assets yourself if you haven't done it yet. And I say that as part of the education process. Your clients are buying it. Your clients understand how it works, and in my experience, the simplest way to do it is to take the plunge and actually put yourself through the experience of what does it mean to own digital assets in your portfolio. Because, as I said, your clients are doing it. And
thanks to everybody for a really great discussion and lots of audience participation in the chat. Lots of fun. Thanks to Mushir and the team for putting together the event and inviting us to be here today. Avaneesh, Henri, Matt, Emma, and myself. Back to you, Mushir.
Thank you very much, Doug. It's quite interesting to hear what you guys have said. Very topical. Education is going to be key, and all of you are involved in that, and I think that's something that we want to drive home. And thank you again for joining us, and thank you to OSL for sponsoring our panel. We will move on to the last segment before the networking session, which is we'll be showcasing 3 very innovative wealth tech solutions. We'll have HedgeTech talk about their risk tech solution. They're one of Israel's top wealth tech companies. Second would be we'll have Neotech, one of Hong Kong's top RegTech firms, talking about their ESG solution, and then Hextrust, which are building a very interesting crypto custody solution and are also based out of Hong Kong. So give us 2 minutes and stay tuned as we come back with the innovative solutions and a jury of Eric Poon, Karina, Belen, and Usman. Thank you.